Hello, welcome, founders. Welcome back to Founderama Live Show. All right, we got an exciting episode today. So, this is just me today. I don't have any guests, but I am going to be talking about a topic that I think a lot of founders will find really interesting. So, as usual, I'm about 30 seconds early. I'm just trying to get in there, let people get a bit of time before I really jump into this topic. This topic is really not only interesting, but also it's almost like a hidden gem, right? It's a hidden strategy that most people, most founders don't know about, and I've seen very few founders or startups, you know, uh, send me pitches that have this strategy in terms of funding, right? Seeking funding. All right. So let me just I think we're completely online now. So let's go and get the show started. All right. So today's topic, how to get funded without giving away equity. All right. That's a bit of a bold statement, but of course, if you're an investor watching this, if you're in the investment sector, when I say a startup funding and all that, you would know that it is indeed possible to, get funding without giving equity away. There are a few different strategies. Today, in this live episode, I'm going to be covering one of them. All right. Okay. So let's get on with our obligatory presentation. First of all, raising funds without giving equity away. What are the different options that founders have? Debt financing, borrowing funds from a bank. This is a tricky one. Yes, you don't give equity away, but you owe the bank. And if your startup doesn't go as planned, then you're exposed, right? So this debt could be, typically what I've seen is personal loans. A few founders do manage to get, business loans, but that's quite rare. So personal loans, especially if you're putting down collateral, like, I don't know, your house or something, then you will be in big trouble. So debt financing, it's a double-edged sword. It could be good if your startup is good, if you're going to have success, right? So you got to go back, like I always say, you got to go back to your idea, to your fundamentals, to validate it, to make sure that you have a solid business plan, and then the team, and blah, blah, and then the plan, and that you will be profitable because you do have, or you will have, paying customers, right? So, okay. Then you have crowdfunding from a large number of individual investors through online platforms. You know what? I'm going to do a separate live episode just talking about crowdfunding. But again, yes and no. It depends on the kind of startup, because crowdfunding does not fit all kind of startups. It depends. You need to have a gadget, and we'll get into that in a different episode. Grants. There are a number of grants available depending on your location, right? So in the US, in the UK, in Germany, France, Canada, there's lots and lots and lots of grants by governments, sometimes even private kind of entities. And these grants can be really a good option, but their criteria are strict. Typically, what I've noticed is they go after really young founders, and also the sector, so clean energy, sustainability, things like that. But again, maybe another episode on that, right? Revenue-based financing, funding in exchange for a percentage of future revenue. And I've seen this with Amazon businesses. So startups that buy an Amazon business or something like that, and then there is a guaranteed MRR, and then they say, okay, would you invest $100,000, for example? There's no equity there, and you will then get 20% of the MRR for this kind of period. So by the end of that period, then you get your capital back, but you also get maybe 20, 30%. Nothing much to say about that. It's really difficult to get that. Then you have the topic of today, safe agreements. Raise funds in exchange for the right to purchase equity at a later date. Okay, we'll dig into that. But before anything, let me tell you that this video is not financial or investment advice, right? I'm not a financial advisor. I'm not an investment advisor. I'm a startup advisor, startup funding advisor. I'm also an angel investor, and I represent family offices and angel investors. So this is for educational purposes only. This is not financial or investment advice. All right, having said that, let's jump straight in. So what is a SAFE agreement? SAFE stands for Simple Agreement for Future Equity. SAFE allows early stage startups to raise money without giving up equity or going through the complex and time consuming process of setting a valuation. Okay, so what does that really mean? Well, investors provide funds to the startup in exchange for the right to purchase equity at a later date. Okay, so how does SAFE work? Let's say, for example, a startup is looking to raise $500,000 in seed funding, or it could be pre-seed funding. An investor agrees to give the $500,000 for the right to purchase equity at a 20% discount when the company raises its Series A round. Okay, this is called a trigger event. Okay, so this is just a hypothetical example. So let's say you have a startup, you're looking for $500,000, an investor comes in, puts in that $500,000 in return for the right, so there's no equity here, for the right to purchase equity, so to get equity down the line at a 20% discount, right? But there is a clause, and it's usually called a trigger event. In this case, as soon as Series A rounding starts, then I, as an investor, will have the right to purchase equity in that at 20% discount. So the investor would receive $625,000 worth of equity in exchange for that $500,000 investment. What that means is, so they put in $500,000 now, they don't get equity in your startup, and then you go through the process. So you use that $500,000 as working capital, whatever, or to get to that trigger event, and then as soon as you get Series A funding, then I, as the investor, or whoever is investing, would then be able to buy, equity. But the equity now is worth $625,000. So if they had come in at that moment, they would have then had, if they put in $500,000, they get equity for $500,000. So let's say that's 10%, whatever, 10% of equity, $500,000. But now, because of this, they get the same 10%, but less. So that means they're getting more. So they get 15%, right? So 625,000, they've already made $125,000. This is a very basic, very simple example. And by the way, if you are an investor watching, if you are a financial analyst, this video is not for you. So don't try and pick holes in this, because I'm trying to simplify this and really explain it so that starting founders who are bootstrapping, they're looking for their pre-seed, they're looking for their seed funding, who may not be aware of all the options out there, they get some benefit out of this. They understand this, okay? So if there's some flaws in this, hey, it is what it is. And again, I said I'm not a financial or investment advisor, right? So, okay, so what is a trigger event? So a trigger event must occur in order for the SAFE to convert into equity, or for the investor to have the right to purchase equity at a discount. Usually, the trigger event is tied to a future funding round, such as a Series A round, or to a significant milestone, such as reaching a certain level of revenue or user growth. Okay, so Let's just talk about the trigger event again with the same example, but slightly different. So, for example, let's say that a startup raises $500,000 through a safe agreement with a trigger event that is tied to the company's next funding round. The trigger event is set such that if the company raises at least $1 million dollars in its Series A round, then the investor has the right to purchase equity at 20% discount. If the company fails to achieve this trigger event, the SAFE agreement then may be converted into equity at a predetermined valuation. Okay, I know the same thing. I'm just repeating because I just want to make sure that you understand what this is. And we'll go into more details, right? Okay, so what about a conversion event? A conversion event triggers the automatic conversion of the SAFE into equity at a predetermined valuation. This may happen if the company reaches a certain milestone, such as a successful exit or acquisition, or if the company fails to achieve the trigger event within a certain time frame. So if we go back to the same example, $500,000, now the conversion event could be set in such a way that if the company fails to achieve the trigger event within 18 months, let's say, okay, 12 months, 18 months, then the SAFE agreement will convert into equity at a predetermined valuation. Now, if the company achieves the trigger event within that 18-month or 12-month, whatever, then the investor has the right to purchase equity at a discount, right? So again, the same thing, but here we have an automatic conversion of equity at a predetermined valuation. Now, when we get to the pros and cons of this, there is a little bit of a conflict here because SAFE funding vehicle for founders I recommend that all the time is because if you can get it, because it's faster and you don't even need to have a valuation of the company. But then here, you're okay. We'll talk about it. And by the way, a little bit of a history lesson here. This SAFE kind of investment funding vehicle was originally created by Y Combinator, right? I think it was back in 2013, something like that. So they came up with this concept, this idea of giving funds to startups without taking an equity, but with the right to purchase equity at a discount or a valuation cap, and we will talk about that at a future date. So that means this helps the founders not dilute their equity when they reach Series A and all that, right? Okay. Right. Now, the pros of SAFE. Fast and easy. They're fairly simple and straightforward with fewer variables to understand and negotiate. This saves time and negotiation, which allows the transaction to move along at a faster and more efficient manner. No interest payment and maturity dates. So this is not a debt financing kind of a thing. SAFE removes features in convertible notes that give startup founders headaches. Okay, so you get something else called convertible notes, which is similar to SAFE, but then convertible notes may have, interest angles and all those things, right? Payments and maturity dates, and SAFE doesn't have that. No repayment of principal. So no obligation on the founders to repay the investment if the SAFE never converts into security. While this can be seen as a negative, as the investors could be left with nothing, most professional seed stage investors understand the risk of investing in early stage startups. So this is a little risky for investors, but most professional investors know the risk. High resolution fundraising. With SAFE, startups can close with an investor as soon as both parties are ready to sign and the investor is ready to wire money. So what it basically means is that it's fast and simple, right? It's simple because you just negotiate the terms of that SAFE agreement, and if both of you That is you as the founder and the investor who is interested in this. If you guys come to an understanding, then it's as simple as signing a safe agreement. And at the end of this video, I will show you a sample safe agreement and we'll go through it just to see what it is. And you can just sign that. And the moment it is signed, that's it. The investor can wire the funds over to your account. So it's fast, it's simple. All right. What about the cons of SAFE? No equity stakes. So this is about the investors. Being a safe investor does not entitle one to the rights of a stockholder. Safes are not equity stakes in the company. So safe investors are not protected under the state corporate law or federal securities law in the US. If the triggering event never occurs, a safe investor can be left with nothing. That is for the investors. What about for founders? Too easy. Because it's become so easy for founders to raise money on safes, many founders raise a bunch of money without understanding the impact on the cap table. Then they have a rude awakening when the safe converts and they realize how much of their company they've given away and how much it has diluted them. Okay, what does that really mean? Let's unpack that. So, you're not giving away equity at the beginning. Let's say your seed round, right? So, pre-seed or seed round. So let's say you get in $500,000 and then you start building the app or the platform or whatever, and you quickly reach um, that the triggering event, right? Sorry, I got a little distracted there. Um, you get to the triggering event, and then if let's say some other investor comes in and they come in at $1 million, right? So the equity now they get an equity at that stage, that investor, but suddenly these safes also convert into equity. So if the investor who's given the safe funding, decides to exercise their right to purchase that equity, then that's it. So you got that 10% going and then another 10% going. So, look, it's not really a con, so to speak. It's just that you got to be careful, right? Okay, so something is happening here with my camera. So let me see what's going on, okay? Just give me 1 second. Yeah, it's let's see why is it okay. Just give me 1 second. Okay. Sorry guys, I don't know, something going on with my camera, but let's try that again. Yeah, much better. So those are the cons. Okay, safe discount or valuation cap. Okay, so there are two kinds of processes within this, right? So one is a discount, which I already explained. So you can buy equity at a discount at a later date. But there's also a valuation cap. So first, let's talk about the discount, and you already know what that is. A discount in SAFE is used as a mechanism to address the higher risk of investment that SAFE investors take when investing in an early stage startup. It is the discount of the price per share paid by the new investors in the equity financing. The discount may range anywhere from 5% to 30%, with 20% being the norm, right? It's in the middle. A valuation cap is the highest valuation at which the amount invested in the SAFE would be converted into shares. It is the maximum valuation that the SAFE investor will pay regardless of the actual valuation of the equity financing. Guys, I'm sorry. My camera is still acting up. Let's see. Oh, okay. No, that's okay. I don't think it is. Sorry, guys. Sorry. I know. I know. Okay, so what is a valuation cap? A valuation cap is the highest valuation at which the amount invested in the safe will be converted into shares. It is the maximum valuation um, that the safe investor will pay regardless. Okay, so what that means is, let's take an example. If the safe valuation cap is set at $10 million, so when the safe agreement is being made between the founder and the investor, and they set the valuation cap at $10 million, right? And when the new investors come in at Series A, and now things have changed, and those new investors come in at a $20 million valuation, because now you're valuing the company at $20 million because things changed and it's better than what you thought, blah blah blah. Then the safe investors will be paying half price for their shares relative to the new investors. So the safe investor can buy twice as many shares for their money, which was the initial $500,000, as the new investor. So if a new investor comes in at Series A and then puts in $500,000, let's say they get 5% of the stock, then the safe investor will get 10%, something like that, right? Okay, I'm just trying to find angles so that it's not too confusing. Okay. Pre-money and post-money valuations. Now, when we talked about the pros and cons, we discussed that safe safe kind of agreements are quick and easy because the company does not need to be valued at all at that stage, right? So somebody's coming in and they're having a right to purchase equity in the future, but not at that moment. So there is no need to evaluate, the company. But that was in the past. Nowadays, because investors want to safeguard, and we're going to talk about what steps investors take to protect themselves in a later slide. But here, let's talk about valuations, right? They do some valuations. You got the pre-money and the post-money valuations. Pre-money is the valuation of the company before the investments take place. Post-money valuation often refers to the company's value after an investment round takes place, like selling a Series A round of stock. This is for understanding valuation cap, right? So, for example, if the safe valuation cap is 10 million and the new investors come in at 20 million, then you know what I said, right? So the safe investor then gets double the number of shares and all that. Okay, the process. How does this work? Very simple process, nothing much to it. You draft a term sheet that outlines the terms of the safe agreement, including the investment amount, discount rate, and trigger event. Send the term sheet to the investor for review and negotiate any changes or clarifications. Once both parties have agreed on the terms, sign the safe agreement. The investor wires the funds to the startup's bank account. The startup can use the funds for working capital or to achieve the trigger event. When the trigger event occurs, the investor has the right to purchase equity at the agreed upon discount rate. If the trigger event doesn't occur within a certain time frame, the safe agreement may convert into equity at a predetermined valuation. So, as you can see, it's not much. It's quite a simple process, and it really depends on the relationship you have with the investor, the understanding that you two have, the terms that you negotiate, and yeah, it's as simple as that. So why would investors go for safe, right? Because there seems to be a lot of risk in this. Well, investors may be interested in safe investment because it allows them to invest in promising startups without committing to a specific valuation or taking on the risks associated with equity ownership. Okay, I'm not going to go into too much detail because this is very nuanced and, you could argue many different scenarios and all that. But first of all, I did do a safe, one or two safe investments back in the day. And the reason I did that was because, so this startups, this startup idea, this founder, comes up to me, and I look at the idea and I see that it could be a brilliant idea, right? So I do my due diligence, I do all that, and if I feel that, the company cannot be valued because there are certain elements that need to be put into place before an evaluation can take place. So I want to invest, but I don't want to invest and take equity at evaluation at that moment, which may not be advantageous to me, right? So the idea is that I would bring in the safe investment, and also I would help the founder put the thing together, make the connections, open doors, a few different things that angel investors usually do, and family offices too. And that way, I can help this founder take that startup to Series A. And the Series A, if I did the job right and all that, and if my hunch was right, then the Series A would be so tremendous that my equity would be much more. So it's really about finding that promising startup. Investors receive the right to purchase. Okay, you know that, and this can provide the return on it without need to negotiate the valuation. So this is exactly my scenario that I explained. So how do investors protect themselves? If the startup fails to use the funds as intended, the investor may have a recourse to demand a refund for their investment or to take legal action to recover their funds. But this can be complicated, and this depends on a set of terms and all that. In some cases, the funds may be held in escrow until certain conditions are met, such as the startup achieving a minimum level of fundraising or reaching a specific milestone. If the conditions are not met, the funds may not be returned to the investor or held in escrow until new conditions are agreed upon. So, yeah, so escrow has become a bit of an idea here. A lot of investors who are going in for safe rounds, they're doing that. They're doing escrow. So, yeah, there is definitely a risk, right? So how do investors protect themselves? Part two, conducting due diligence. Oh yes, you need to be sure that this would be a winning idea. You got to be really sure. And you got to negotiate favorable terms. So this part is for those angel investors who may be watching this video and thinking, okay, how do I deal with a safe, right? So you got to negotiate favorable terms. It's not, and on those favorable terms is not just about the percentage of the future equity. No, it's about different scenarios. Okay, what would happen if this happens? What would happen if your co-founder drops off or drops dead or whatever? What would happen with this? What would happen with that? So you got to think through that, and usually thinking through that requires experience. So if you're a budding amateur angel investor, you got $100,000 that you're passionate about startups. Yeah, be careful. And of course, diversifying their portfolio by investing in multiple startups with different risk portfolios. Providing support and guidance to the company through mentorship, introductions, and other resources. Oh yeah. So in the previous slide, this is what I was talking about, which is what I did. So when I went into a safe investment round, I made sure that my investment was protected. So at that time, if I remember correctly, it was about $250,000, which was a lot of money for me. And if I lost that, I'll be destroyed. So I made sure. So what I did, I mentored the founder. I made connections, introductions. I put teams together. I coordinated some of the stuff, all that. Okay. What about 3? With the post-money safe agreement, the investor and company agree on a post-money valuation cap. Post-money valuation simply means the total of the pre-money valuation plus any new money or assets raised. Investors like this agreement because at signing, they get to lock in the percentage of the company they will own when the triggering event occurs. The post money safe is clear and simple and more friendly for investors. With this agreement, the investor share will not get diluted. So these are different ways that investors, try and protect themselves. Okay, what about the downside for founders with post money safe agreements, right? There is a downside because of the post money valuation cap. The founders stand the chance of getting some dilution on their eventual ownership share. Although the company will get their money faster by using a post money safe agreement, the founders might experience more dilution than with other types of fundraising agreements like convertible notes or KISS, keep it simple, security agreements. So there are others which I will talk about maybe another live episode. So with this one, if it is post money valuation cap, if that is part of the safe agreement, then you got to be a little careful. Okay, so if you're a founder, try to agree to the maximum valuation, future valuation, and if you're an investor, agree to the lowest valuation. Okay. Yeah. Well, I'm lucky because I get to play the two sides of the table because I am an investment advisor. So I help founders and startups, and I put them in front of family offices and other investors. But I'm also an angel investor, and I was an angel investor. So I play both. And of course, I'm a startup founder. In fact, I've just recently started. I've exited in the middle of an exit, a massive exit, and that's not even complete. The ink is not yet dry, and I've already started a stealth startup. So it gives me, an insight into both sides of the game. All right. Examples of family offices that invest in safe deals. Middle East, Beko, Braid, MEVP, Wamda, and Mubadala. USA, you got Winklevoss Capital, Chan Zuckerberg, Kapoor, Fisher, and Pritzker Group. Okay, so these are just a few examples of family offices, both in the Middle East that I know of. I know these really well, and USA. Okay, so typically, if you're a founder and you're looking for anything less than $500,000, you're better off finding one or two or more angel investors to do a safe agreement with, right? But if it's slightly more, or even $500,000, you could go for family offices. And family offices tend to be kind towards safe agreements because they are not like venture capital or, well, I know people are going to flame me for that, but my opinion, and this is my show, so I'll tell you my opinion. VCs very aggressive, family offices not so much. Yes, they do want a return on their investment, but they also are willing to step back and give the founder time to do what they set out to do, and so on. So yeah, this is, these are some examples. But guys, as I always say, don't just, not only these, but don't just go out there and start looking for, angel investors and family offices and start sending out, what do you call these, safe agreements and saying, because look, if you want to send out safe, if you want safe, then the best thing is, just give me 1 second. Sorry about that, guys. Okay, so the best thing to do is to really evaluate your idea and to say, is my startup, is my venture safe worthy? Because no investor is going to come in and risk their money without a current equity stake, unless your idea is groundbreaking, unless your idea is so good that, it's just out of this world. So guys, please, please, please be careful. Because the reason is, yeah, some of you might say, what am I going to lose? And I've seen a lot of safe pitches come in on my desk, and I look at those ideas, and they're just normal ideas. They're just regular. They're replicable. There's nothing groundbreaking, and yet these guys are asking for safe at a 20% discount, and they think it's probably a good idea. And I say no, no, because look, it's an opportunity cost. You're wasting time going after investors and asking them for safe when your idea is not safe worthy. Anyway, as I said, let me show you a sample safe agreement. Here is a sample safe agreement from Y Combinator. And you can find a lot of information on their site. But look, you got the discount rate here, right? So you put the discount rate here, 20, 30%, whatever it is. Then you got some events. You got the equity financing event, liquidity event, right? There's the conversion amount here. Then there's a dissolution event, liquidation priority. So what happens if something happens and the startup has to be liquidated, right? So what happens? Then priority, who gets what, who gets when, blah, blah. Senior to payments, common stock termination, and then, change of control, director list and discount price. Then you have company representations, investor representations, and all that, right? But like I said, guys, I'm not an investment advisor, and I'm not, a financial advisor. I am a funding advisor. So, let me go and see if there's any comments. Yes, there are some comments. Let's talk about that. Okay. Safe V2, yes. Simon, my friend who came in live yesterday, says there's a Safe V2 from Y Combinator. Yes, that's correct. Josh Rodriguez says, should a founder already have a legal entity and or an idea, concept, patent before approaching investors at any level for any funding amount? What? Should a founder? Oh, okay. So Josh Rodriguez has an excellent question. He says, should a founder already have a legal entity, that is LLC Corp, or idea, concept, patent before approaching investors at any level for any funding amount? Okay, very interesting question, Josh. And really, yeah, a lot of people are confused about this. They probably don't know because it can be very confusing. Okay, now, having a legal entity protects you. So it's always a good idea to have a legal entity. And, any agreements you enter into, especially if it's a limited liability company or whatever, again, I'm not an attorney. So whatever I'm telling you is based on my experience. And it's just for educational purposes, right? So you got to talk to your attorney about these things. But having said that, yes, it's always a good idea to have a legal entity if you can. That will cost you nothing. But having a legal, an idea or a concept patent, that is more tricky because patenting process can be time consuming and expensive. Attorney costs, patent application costs, and all that. But if you do have the resources and the time to do that, so let's say you're fleshing out your prototype or your idea, you're bootstrapping it, and you have some cash that you can put towards patenting your idea or your concept, do it. Do it by all means. In fact, as soon as you apply and you have a patent pending kind of certificate, that's pretty good actually. When you enter into negotiations with investors, investors would look at that. Of course, it doesn't mean that you got the patent yet, but it shows that you're doing your due diligence, that you are a founder that is switched on, that is thinking about everything else, and is making the right kind of is taking the right kind of approach with respect to your idea. So yeah, that's a good idea to do. All right, people. Any more questions? Okay, none. All right, so I hope you found this episode useful. I think it's a good strategy to get funded without giving away a lot of equity or no equity to start with. I tried to cover what it means in detail. I gave a couple of examples. I also covered the advantages and potential disadvantages. So please look into these. Now, if you want to go down this route, think through. The main thing is your idea, your startup, your venture, your profitability, and the potential. Because otherwise, you're going to be wasting time sending safe applications to investors. I get a ton, and one look at the idea, and I laugh. No, literally, I do laugh because I think, okay, these guys are, especially when they are asking for $500,000, and they're offering me a safe agreement um, at a 20% discount, and the idea is pretty average, right? Okay, Josh again asks another question. What defines if an idea is able to be patented or not? Uh, okay, that is not a question I can answer because an idea is patentable or not depends on a ton of factors, right? First of all, it got to be unique and it has to have utility. Now, I'm talking from a startup funding perspective, right? Not from an invention perspective. Because you could have inventions that may never make any money, but they are valid inventions and therefore you might get a patent. This reminds me of a guy that I follow on Twitter and YouTube. Uh, Slips my mind, but he does these what are they called? Unnecessary inventions or something, right? He posts these really great videos of unnecessary inventions. Yeah. So, but inventions can be patented, but when it comes to ideas in terms of funding, in terms of startups, in terms of investors, I would say the idea needs to have utility. Would it make money? Would people be willing to pay money for this? If they would, and you have vetted that process, then you got to go for a patent. And also, of course, your patent, the idea should be complex enough to be patented. And the best thing is to contact a patent attorney, right? They will do a basic search first to make sure that it's not already been patented, because you'll be wasting your money. It's non-refundable government fees and the attorney fees. You're better off spending a little bit of amount, hiring an attorney to do a basic patent search just to make sure, just like a trademark search, right? And so on. But like I said, you're better off contacting a patent attorney. All right, my friends, this is it for this week. Tomorrow is off. I'll be back Monday with another live episode. This one is an important topic, so if you have questions, if you're watching this as a replay, please post your questions and I'll be watching out this page and I will try and answer them, okay? And if you have an investment opportunity that you want to go for safe and your idea is fantastic, send it to me, okay? Send it to me and I will take a look at it because I do know of family offices that are kind to safe agreements. Okay, one last question come in. Peter Kize asks, is registering the startup as a corp or a LLC better? I know they're taxed differently. Okay, Peter, I cannot answer that. I'm not a tax attorney. I'm not a company's attorney. Therefore, I don't want to give any misleading information here. Register the startup as a corp or an LLC. I don't know. You gotta either read up on that, or better yet, these days the prices have come down. So just get pay an attorney to get some advice. All right, founders, thanks so much for coming on this live episode. Follow me on LinkedIn. Leave some messages there if you have questions, or send me your pitch decks. If you want me to jump on your startup as an advisor, hit me up, DM. We can schedule a call. Or if you need some helping with funding, direct matchmaking, whatever. But make sure your idea is good, yeah? Because I'm just going to laugh at it when it comes onto my desk. All right, so till the next episode, which is on Monday, go forth and prosper. Take care, guys. Have a great weekend.